In the spring, market analysts noticed something unusual. Bitcoin's behavior didn't look entirely organic. It moved with surprising consistency, sometimes ignoring news, sometimes reacting in patterns that looked more mechanical than emotional. When researchers compared these movements to institutional risk model updates, they noticed correlations that raised questions. Not proof, but signals worth examining. Some experts began discussing a new possibility. Bitcoin might be serving as an early testing ground for broader financial digitalization, and among the institutions capable of influencing this process through infrastructure, one name appeared more often than others: BlackRock. BlackRock is known as the world's largest asset manager, but specialists frequently point to something far more significant than its size: the Aladdin platform, a system used across global finance to evaluate risk, liquidity, and market behavior. According to public reports, Aladdin supports decisions that indirectly affect pensions, banks, insurers, and investment funds. To most people, BlackRock is simply the firm that launched a Bitcoin ETF. But analysts argue that this connection introduces something new. For the first time, major traditional finance infrastructure is touching the crypto market at a structural level. When BlackRock filed for a Bitcoin ETF, many saw it as mainstream acceptance of crypto. However, experts suggest the real significance lies elsewhere. The ETF connects Bitcoin to institutional analytics. Coins held within the ETF become part of large-scale risk assessment models, feeding information into systems that interpret market flows. In this framework, Bitcoin behaves not only as an asset, but also as data used to understand and navigate global capital movement. Economists highlight that BlackRock's long-term interest focuses less on Bitcoin's price and more on tokenization, the idea that any asset, from bonds to real estate, could exist in programmable digital form. Larry Fink has repeatedly spoken about a future where markets are digitized end-to-end. In this context, Bitcoin becomes a proof of concept, a real-world example of how an asset can function inside a digital architecture. If the mechanism works for crypto, experts suggest it may scale to the broader capital markets. Some analysts noticed that certain Bitcoin movements mirrored institutional activity cycles rather than retail sentiment. Again, not evidence of control, but patterns that encouraged deeper investigation. This raised a question: how closely are traditional financial systems and digital assets becoming intertwined? And where is the boundary between regular market dynamics and automated institutional behavior? Research groups compiled 3 observations: institutional algorithms shaping capital allocation trends, custodial structures supporting ETF operations, price cycles that occasionally aligned with large-scale financial activity. Experts describe this as environmental influence, not direct interference, but the shaping of the conditions in which crypto functions. In modern finance, changing the environment can be just as impactful as participating in the market itself. If tokenization accelerates, analysts believe crypto may shift from an alternative system to an integrated component of global finance. ETF, tokenized assets, digital risk models, coordinated capital flows. In such a scenario, Bitcoin becomes the first example of how a digital asset interacts with institutional infrastructure, rather than standing outside it. People focus on how much Bitcoin BlackRock holds. But experts suggest a different question: what role will BlackRock's infrastructure play in a world where assets of every kind could exist digitally? If Bitcoin is only the prototype, then the real story is the creation of a new financial framework, and it may be better to follow its development now than to encounter it fully formed later. To stay ahead of this shift, keep watching and subscribe.